Dear students, in our previous videos, we have learnt as to how to compute the total income of companies and also computation of tax liability thereon. But sometimes what happens is a company might have generated the income during the year, but it may not have paid any tax at all, or may have reduced its tax liability by taking advantage of various provisions of income tax law like deductions, exemptions, depreciation, etc. In other words, the number of companies paying zero tax is on the increase in the recent past. So these companies, they make use of the entire public infrastructure like roads, airport, harbor. They pollute the environment, but still they do not contribute anything to the society. They don't pay any tax at all. Therefore, as a remedy that every company has to pay some tax, minimum alternate tax was introduced in the Finance Act 1987 with effect from the assessment year 88-89. It was withdrawn by the Finance Act 1990 and then reintroduced by the Finance Act 1996 that will come into effect with 1st April 1997. The concept of MAT is governed by the provisions contained in Section 11B of Income Tax 1961. Okay, where in the case of company, the income tax payable on its total income in respect of any previous year relevant to the assessment year commencing on or after 1/4/2020 is less than 15% plus surcharge if any plus health and education cess together of its book profit. Such book profit shall be deemed to be the total income, and the tax payable on such total income shall be the amount of income tax at 15%, including the surcharge, plus surcharge if any, and health and education cess of such book profit. Let me once again tell you what I have already explained. So first you have to calculate the total income. Then again you have to calculate 15% tax on book profit. 15% in the sense 15% plus surcharge if any, and then health and education cess. Of the two, whichever is high, that is the tax liability. In other words, if the tax paid by the company on total income, if it is less than the tax on book profit at the rate of 15% plus surcharge plus cess, then MAT is applicable. MAT means minimum alternate tax. As I already told you, some companies either do not pay the tax at all, they manage to see that they don't pay any tax at all, or they pay lesser tax by claiming exemptions, deductions, depreciation, etc. So to avoid that, the government has introduced MAT or minimum alternate tax. Every company has to pay some amount of tax to the exchequer or to the government. That is the intention of MAT. So here the principle is tax liability of a company where MAT is applicable is tax on total income or tax on book profit, whichever is high. So that is the formula where MAT is applicable. Now let us look into the specifics of this MAT provisions. So what is the procedure for application of MAT? It should be MAT, M-A-T, minimum alternate tax. So first find out the normal tax liability on total income. So normal tax liability means what? Already you have learned in the previous chapter under computation of total income. First you have to compute total income. That means first you have to take taxable income under each head, like income from house property, business income, capital gains, and income from other sources. Then therefrom we have to deduct deductions applicable under 80, section 80. So the deductions should be reduced from the gross total income. Then you will get the then you will get total income. On the total income, you have to calculate the taxes. How do you calculate the taxes? You have to find out of the total income whether there are incomes where special rates are applicable, right? Like short-term capital gains taxable at 15%, long-term capital gains taxable at 20%. Then casual incomes like lottery income or winning from crossword puzzles, horse race, such other items. So that way you have to calculate. On the balance you have to calculate tax at the rate of 30% in the case of domestic companies and 40% in the case of foreign companies. And surcharge is applicable if the total income exceeds 1 crore and the rate is in the case of domestic companies 7% and in the case of foreign companies it is 2%. And if the total income exceeds 10 crore, then the rate is 12% in the case of domestic companies and 5% in the case of foreign companies. Okay, so find out the normal tax liability on the total income, find out the book profit. So how to compute the book profit I will let you know a little later. In the next step I will tell you. Find out minimum alternate tax. Minimum alternate tax is on book profit you have to calculate 15% plus surcharge if any, and then cess, that is health and education cess, that you have to find out. If MAT is equal to or less than the normal tax, MAT is not applicable. To give an example, supposing the tax payable on the total income is 3 lakh and 15% tax on total book profit along with the surcharge if applicable and cess, that's also 3 lakh, then MAT is not applicable. So if you have to apply the MAT, tax on book profit should be more than tax on total income. Okay. If MAT is more than the normal tax, the provision of MAT is applicable as under. It will be assumed that the book profit of the company is its taxable income. So if MAT is applicable, then book profit is taken as the total income or taxable income. Then 15% of book profit, earlier it was 18.5%, now it has changed. So 15% of book profit plus surcharge if any and health and education cess 4% on the total of tax at the rate of 15% plus surcharge is the tax liability of the company. Section 115JB is not applicable if the business is carried on by the company in a special economic zone. So MAT is not applicable if the business is carried out by a company in a special economic zone. The company shall be liable for MAT. The company shall be liable for MAT. The extra tax which the company is liable to pay because of MAT, that is MAT minus normal tax, will be available for MAT credit or tax credit under section 115 JEE. It can be set off against future tax liability provided normal tax is greater than MAT in that year. Supposing this year MAT is 3 lakh and tax on total income is 2 lakh, then the MAT credit is 3 lakh minus 2 lakh. 1 lakh is the MAT credit. So this can be carried forward. And next year, supposing the total income, tax on total income is say 2 lakh, and tax on MAT is tax on book profit. In other words, MAT is say 1,50,000. Then next year you can reduce from the tax liability of 2,50,000, the difference between the two. So that can be reduced tax credit. So you need to pay only 1,50,000, not 2 lakh. Okay. So more about this you will learn well when I solve the problems. What is book profit? Again, I'll give a list of that while solving the problems. Then and there only I will explain in detail. Book profit means the net profit as shown in the profit and loss account, prepared as per provisions of Part 2 and Part 3 of Schedule 6 to the Companies Act, is increased by the following amounts if debited to the profit and loss account. In other words, net profit as per the profit and loss account should be increased by the following amounts if they are debited to profit and loss account. Now, what are those items debited to profit and loss account? The amount of income tax paid or payable and provisions thereof. On the debit side of profit and loss account, you may find income tax paid or provision for income tax. So these are not allowed. Therefore, these are to be added back to net profit, which is shown by the profit and loss account. Next one, the amounts carried to in reserve by whatever name called. For example, in the profit and loss account, there might be an item transfer to general reserve. Then what you have to do is you have to add back that value because that's not allowed while computing book profit. Amount set aside to provisions made for meeting liabilities other than ascertained or known liabilities. So amount set aside to provisions. Amount set aside or provisions made for meeting liabilities other than ascertained liabilities. So these are also to be added. Amounts by way of provisions for losses of subsidiary companies. The amount of dividend paid, either paid or proposed. The expenditure relatable to income to which section 10, 11 and 12 applicable. For example, section 10, it might be HRA, or it may be death cum gratuity, or it may be encashment of leave salary on retirement. So all those items come under section 10. So similarly 11 and 12. Amount of depreciation which is debited to profit and loss account by the accountant. Amount of deferred tax and provision therefrom, and the amount set aside as provision for diminution or decrease in the value of an asset. So deferred tax arises on account of differences in timings. Okay. Amount standing in revaluation reserve related to revalued asset on the retirement or disposal of the asset. Okay. Amount of income or loss in the case of units referred to in section 47, subsection 12. Next, these are the amounts we added to net profit in order to calculate the book profit. Now, what are the items to be deducted? The amount withdrawn from reserve or provisions, if any, such amount is credited to the profit and loss account. The amount withdrawn from reserves or provisions, if any, if that amount is credited to profit and loss account earlier. Income tax exempt from tax. Income that is exempt from tax. That is the amount of income to which section 10, 11 or 12 applies. If such amount is credited to profit and loss account other than section 10A and section 10B. Okay. The next, depreciation debited to profit and loss account except depreciation on revaluation of assets. In some problems you may find depreciation is once added back and same amount is deducted. But while deducting, if there is depreciation on revaluation of assets, that should be excluded while calculating the book profit. Amount withdrawn from revaluation reserve credited to profit and loss account to the extent it does not exceed the amount of depreciation on account of revaluation of assets. This point I will explain while I take up a problem. The amount of loss brought forward or unabsorbed depreciation, whichever is less as per books of accounts. So you may be having uh, unabsorbed depreciation or brought forward loss on two counts. So one is as per books of accounts and the other one is for tax purposes. So here you have to take least of the two as per the books of accounts, not as per, not for the purpose of tax. The amounts of sick industrial company for the assessment years commencing on and from the assessment year relevant to the previous year, in which the said company has become sick industrial unit. The amount of deferred tax, if any, such amount is credited to profit and loss account. Amount of income or loss in the case of units referred to in section 47, subsection 17. There also I am subject to correction. Is also 17, not 12, 17. Okay, now look at the notes. So after considering the above adjustments, the book profit is arrived at. So certain items you have to add to the net profit which have been debited to profit and loss account, and certain items you have to deduct from the net profit as shown by the profit and loss account. So these individual items I shall explain when I take up the problems. There you will be able to comprehend better. Okay, notes. Certain notes regarding the computation of book profit. The company cannot debit the loss of subsidiary company directly to the profit and loss account. It has to make a provision for the same. Therefore, even if the profit and loss account contains a loss of subsidiary company, it must be taken as provision for loss of subsidiary company. So, loss of subsidiary company cannot be directly debited to profit and loss account. Therefore, it should be provision for loss on subsidiary company. But then even if simply loss of subsidiary company is given, then it must be taken as provision for loss of subsidiary company. Only the income tax can be added. If income tax is debited to profit and loss account, that should be added, not interest under Income Tax Act. Then, STT is not income tax. Security transaction tax is not income tax. Hence, cannot be added as per CBDT, Central Board of Direct Taxes circular. Then dividend tax under section 115O and income distribution tax payable by mutual funds under section 115R are additional income tax and hence to be added back. From assessment year 1819, the reference section 10E, that is the compensation received by the assessee on voluntary retirement in the case of Industrial Dispute Act. So if employee is removed, compensation received by the employee, so that is not to be deducted. And then 10B, that's regarding the 100% export oriented company. Earlier 100% deduction was allowed to such companies, but now it is not. Is omitted and hence the income under section 10E and 10B is subject to MAT. From the assessment year 2007-8, long-term capital gain on equity shares or units of mutual fund exempt under section 10 subsection 38 will be added to book profit. That's part of book profit. Okay, certain examples you can take. Tax credit in respect of tax paid on deemed income of certain companies, and tax credit in respect of minimum alternate tax on certain companies under section 115GWE. This is regarding applicability of MAT, explanation of whatever we have already learnt. The tax credit shall be the difference between the tax paid under MAT and the tax payable on the total income computed under the provisions of the Act. Simply saying, tax on book profit, that's nothing but minimum alternate tax, minus tax on total income. The difference is nothing but MAT credit. Okay, Suppose the tax payable on total income is 20,000 and the tax has been paid under MAT rupees 50,000. The tax credit will be 50,000 minus 20,000, it is 30,000. So difference between the MAT and the tax on total income. The tax credit will be allowed to be carried forward for a maximum of 15 assessment years, succeeding the assessment year in which the credit becomes allowable. Suppose the credit is allowable in the assessment year 18-19, it can be carried forward and set off up to the assessment year 2033-34 for 15 years. Alright, next one. The tax credit will be allowed in the year in which the tax payable on total income is more than the tax payable under MAT, say section 115JB. For example, here MAT is 50,000 and the tax on total income is 20,000. So 30,000 is the credit. Supposing next year tax on total income is say 40,000 and MAT is say 20,000. Then the tax payable is as per the total income, that is 40,000. But in that case, you can make use of tax credit. Tax credit to the extent of difference between the two, that is 20,000. So 20,000 can be reduced from 40,000. So only 20,000 you need to pay. Of course, tax credit might be 30,000, but entire 30,000 you cannot make use of in that financial year because the difference between the two in that financial year is just 20,000. So from 40,000 you reduce 20,000. So 20,000 is the tax payable. Alright, look at the example further here. Set off will be allowed to the extent of an amount equal to the difference between the tax payable on the total income and the tax payable under MAT under section 115GB. Suppose brought forward tax credit is 40,000. The tax payable on the total income is 1 lakh and tax payable under MAT under section 115GB is 80,000. Now here 20,000 can be set off this year and the company will pay 80,000 only. In other words, 1 lakh minus 80,000, 20,000 you can avail this year, whatever may be the credit there. In the MAT credit, there might be 1 lakh, but still you cannot make use of it. Just you can make use of 20,000. No interest shall be payable on the tax credit. The provisions of the section shall not apply to a domestic company which is paying tax under section 115BAA. So this is a new provision. So wherever this provision is applicable, in that case MAT is not applicable. Okay. Thank you very much. We'll continue with some more videos in the next subsequent classes.